Art versus gold. Will traditional and AI art retain their value in a financial reset? 2026 reassessment. When I first explored the question of art versus gold in April 2025, the premise still carried a sense of theoretical distance. Gold was climbing, geopolitical tensions were simmering, central banks were accumulating reserves, and artificial intelligence was beginning to unsettle creative industries. Yet the word reset still hovered at the edge of mainstream discourse, spoken cautiously as though acknowledging it too directly might accelerate it. Less than a year later, the tone has changed. Gold is no longer merely appreciating, it is being repriced. Its rise has not been driven by speculative exuberance but by structural anxiety. The surge reflects a deepening distrust in monetary systems, in sovereign debt trajectories, in political cohesion across once stable alliances. Capital is not chasing yield, it is seeking refuge. That distinction matters. Yield is opportunistic, refuge is existential. The renewed momentum behind gold reveals something profound about the current moment. For decades, modern finance functioned on the assumption that liquidity could always be engineered. Central banks intervened, markets recalibrated, and crises were contained within technical language, stimulus, easing, forward guidance. But as global debt expands into unprecedented territory and geopolitical fragmentation intensifies, confidence itself has become fragile. Gold rises when confidence erodes. It is not a bet on growth, it is insurance against fracture. This reframes the original question. In a world where the architecture of globalization appears less cohesive and more multipolar, what truly retains value? Is it the hard neutrality of gold or the cultural and symbolic capital embedded in art? And where does AI-generated creativity fit within this hierarchy? Gold's resurgence signals more than inflation hedging. It signals the return of hard value. Central banks do not accumulate bullion because it is fashionable, they do so when trust in currency systems requires reinforcement. When nations hedge against sanctions, currency weaponization, and trade realignments, gold becomes a silent anchor. It is apolitical, borderless, and universally recognized. In times of systemic doubt, these qualities outweigh volatility. Gold's price, therefore, becomes less a market metric and more a referendum on faith in the existing order. Art operates differently. Its value is not anchored in elemental scarcity alone, but in layered meaning, provenance, authorship, cultural resonance, narrative continuity. In stable eras, art flourishes because surplus wealth seeks expression. Collectors compete not merely for objects, but for stories. Museums expand, galleries proliferate, speculative enthusiasm intensifies. Art becomes both an investment and a signal of identity. It is cultural liquidity converted into tangible form. Yet art's strength is also its vulnerability. It depends on confidence, on networks of trust, on the willingness of buyers to project future relevance onto present acquisitions. In times of contraction, discretionary markets tighten first. The mid-tier art ecosystem, emerging artists, trend-driven works, speculative acquisitions, often feels the pressure before blue-chip masterpieces do. History shows that during economic stress, the art world bifurcates. Museum-grade works by historically validated figures can behave almost like cultural gold, retaining or even enhancing their value as ultra-wealthy collectors seek durable status preservation. Everything else, however, becomes more fragile. The distinction is not purely financial, it is psychological. When uncertainty dominates, buyers gravitate toward assets whose legitimacy is beyond dispute. A Renaissance master or a universally recognized modern icon carries institutional backing, scholarly validation, and historical endurance. These qualities mimic the properties that make gold compelling. They are scarce, globally acknowledged, and embedded within long-term narratives of civilization. In contrast, speculative contemporary works rely heavily on the momentum of present taste, a momentum that weakens when liquidity recedes. Into this already complex landscape enters AI-generated art, accelerating questions about scarcity and authenticity. If traditional art derived much of its value from the uniqueness of human authorship, AI destabilizes that premise by introducing abundance at scale. Generative systems can produce thousands of visually sophisticated images in moments. Style becomes replicable, aesthetic fluency becomes democratized, production costs collapse toward zero. In economic terms, this resembles cultural hyperinflation. Abundance shifts value. When images become infinite, scarcity migrates elsewhere. The worth of AI art cannot rest in the object itself, it must reside in context, who curates it, how it is framed, the ecosystem it inhabits. AI-generated work may command attention, provoke debate, or anchor immersive worlds, but its value as a discrete artifact struggles against the logic of infinite supply. Unlike a Renaissance painting, whose material presence and historical lineage cannot be duplicated, AI art exists within infrastructures, platforms, algorithms, data systems that are themselves mutable. This does not render AI art meaningless. On the contrary, it may deepen its cultural significance. AI art reflects the anxieties and aspirations of an era defined by automation and synthetic intelligence. It mirrors society's negotiation with authorship, labor, and identity, but its economic profile differs fundamentally from that of gold or blue-chip traditional art. It behaves more like media than like treasure. Its value fluctuates with technological power structures rather than with geological scarcity. In the context of a financial reset, whether gradual through inflation and debt restructuring or abrupt through geopolitical rupture, the hierarchy of value clarifies. Hard assets anchored in physical scarcity and universal recognition stabilize first. Cultural assets anchored in institutional validation stabilize later. Algorithmic outputs tied to technological ecosystems fluctuate alongside the systems that generate them. Confusion arises when these categories blur, when speculative enthusiasm elevates infinitely reproducible images to the status of enduring stores of wealth. The current environment suggests we are in a phase where survival assets overshadow narrative assets. Gold's ascent reflects not exuberance but caution. Markets are pricing in fragmentation, trade blocs realign, currency debates intensify, sovereign debt burdens strain political consensus. In such moments, certainty commands a premium. Gold provides that certainty through millennia of collective agreement. Its value does not depend on a curator, a platform, or a brand. It depends on elemental scarcity and historical trust. Yet to conclude that art loses relevance would be short-sighted. Civilizations require more than survival. After periods of contraction, culture resurges with renewed force. Hard assets dominate during fear, symbolic assets expand during reconstruction. Art's deeper function is not merely to store wealth but to store meaning. Even in times of instability, societies protect their masterpieces because they encode identity. The Parthenon's marbles, Renaissance frescoes, national museums, these endure not because they are liquid but because they are anchors of collective memory. The future, therefore, may not be a binary contest between art and gold but a sequencing. In moments of acute instability, capital retreats toward what is undeniably real. As systems recalibrate, attention returns to what is symbolically enduring. Traditional art with deep provenance may retain its stature precisely because it bridges both domains. It is tangible yet narrative, scarce yet meaningful. AI art, meanwhile, will likely flourish as an engine of cultural experimentation and immersive storytelling, but its role as a store of value will depend less on individual images and more on the ecosystems and intellectual properties it supports. What the past year has clarified is that the notion of a financial reset is no longer speculative rhetoric. Structural shifts are underway, visible in central bank behavior, commodity pricing, and geopolitical alignment. Gold's rise is a signal flare illuminating underlying doubt. Art's trajectory will respond accordingly, separating enduring cultural anchors from speculative excess. AI art will continue to challenge definitions of authorship and value, but it will do so within a hierarchy increasingly shaped by scarcity and trust. In the end, gold and art represent different dimensions of human civilization. Gold embodies the oldest agreement about value, neutral, elemental, unyielding. Art embodies the oldest expression of meaning, subjective, layered, reflective. During contraction, humanity leans toward what is certain. During renewal, it turns toward what is expressive. The present moment suggests we are still leaning towards certainty. If a reset unfolds fully, gold will likely stabilize first, absorbing fear and anchoring capital. Traditional art of undeniable provenance may follow, preserved as cultural capital within elite and institutional frameworks. AI art will continue expanding the boundaries of creativity, but its economic role will align more closely with media, networks, and narrative ecosystems than with vaults and reserves. The question then is not simply whether art or gold retains value, it is which form of value humanity prioritizes under pressure. When systems tremble, people ask what is real, what endures without mediation. For now, the answer has been gold. But when stability returns, and history suggests it eventually does, meaning will once again command its own premium.